Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, my name is Husnawia and I'm going to presentation about supply chain finance. Okay, what is supply chain finance? Supply chain finance is an agreement in which the buyer partners with a financial institution that will then pay suppliers on the buyer behalf. These suppliers may have to sign up for the program, but the onus of setting it up is on the purchasing company. After business buys something from the suppliers, the seller can request an early payment, and the financier, often a bank, will quickly pay them a small fee. The purchasing company, they pays the founder at a certain agreed upon that in the future. The central benefit of supply chain finance, also called reverse factoring, is that suppliers can be paid in a matter of days, and a buyer may get long term than those provided by suppliers. This can strengthen the financial position of both parties by increasing cash flow and working capital. Companies may use the option only as necessary, like during the slow season, if they experience seasonal spikes and dips in demand. Okay, next, how supply chain finance work? Okay, number one, buyer-suppliers relationship. Okay, a buyers and a suppliers establish a commercial relationship for the purchases and delivery of goods or service. They negotiate the terms of payment, which often involve extend payment term from the buyers to the suppliers. Number two, suppliers invoice. The suppliers delivers the good or complete the service as per the agreement and issues an invoice to the buyer. The invoice specific the payment amount, payment terms, and payment due date. Number three, financing over. The buyer, in collaboration with a financial institution or a third-party supply chain finance provider, extends financing over to the suppliers. The over allows the suppliers to reserve early payment for the approved invoice, usually before the original payment due date. The financing offer may include a discount or a fee that the suppliers need to consider when this is deciding whether to accept the early payment. Number four, suppliers acceptance. The suppliers evaluate the financings over and decides with her to accept it. By accepting, the suppliers opts to reserve early payment for the invoice from the financial institution. This early payment is usually a percentage of the face value of the invoice minus an applicable fee or discount. The suppliers may choose to accept the over based on their cash flow needs, the cost of financing, and the discount rate providing. Number five, payments settlement. On the original payment due dates specific in the agreement, the buyer tells the invoice by paying the financial institution Our supply chain finance providers instead are directly paying the suppliers. The financial institution reserve the full invoice amount from the buyer, effectively closing the financial transaction. Number 6, repayment. The suppliers in turn repays the financial institution or supply chain finance provider based on the agreed open terms. The payment terms may vary depending on the specific agreement and may include interest or fee on the early payment reserve. Okay, next. What are the advantage of using supply chain finance? The advantage for as suppliers, number one, relatively faster liquidity process, and number two, maintain stability and smooth cash flow. For as a buyer, number one, easy and fast process, securing working capital, and increase sales volume. Each bank or other financial institution that has this service is competing for the attention of sellers and buyers. Usually, the value of competitive interest rates is one of the attraction that is highlighted. Okay, next. Why supply chain finance is important? Number one, improve cash flow for suppliers. Okay, one of the primary advantage of supply chain finance is that it provides suppliers with access to early payment for their invoice. This helps alleviate cash flow challenge that suppliers often face due to extended payments term enforced by buyers. By receiving early payment, suppliers can improve their working capital, fulfill their financial obligation, invest in growth opportunity, and maintain a healthy financial position. Number two, enhance buyer-suppliers relationship. Okay, supply chain finance promotes strong collaboration and trust between buyers and suppliers. By offering early payment option, buyers demonstrate their commitment to supporting their suppliers' financial well-being. This can lead to improve buyer-suppliers relationship, increase suppliers' loyalty, and even potential cost saving negotiate between parties. Number three, working capital optimization for buyer. Buyers can optimize their working capital by extending a payment term without negatively impacting the suppliers. This allows buyers to preserve their own cash flow and utilize their working capital for other business needs such as investment in innovation, expansion, or inventory management. By implementing supply chain finance, buyers can strengthen their financial position and maintain healthy cash flow. Number four, risk mitigation. Okay, supply chain finance can help mitigation risks associated with supply chains disruption. By ensuring suppliers have access to readable and timely financing, it reduces the likelihood of financial distress among suppliers. It lowers the risk of production delay, quality issues, or supplier default that could negatively impact the buyer operation. Number 5, access to financing for suppliers. For many suppliers, accessing affordable financing can be challenging, especially if they lack established credit history or collateral. Supply chain finance providers an alternative financing option that leverage the buyer's credit worthiness, allowing suppliers to obtain financing at more favorable terms than might otherwise receive from traditional sources. This can help small and medium-sized enterprise or suppliers in emerging markets gain access to working capital and fuel their growth. Number 6, revenue generation for financial institution. Financial institution or supply chain finance providers can generate revenue by offering supply chains finance solution. They earn fee or interest on the financing provided to suppliers and benefit from the volume of transaction within the supply chains. Supply chains finance expand the scope of financial servicing over by institution and creates additional revenue returns. Okay, next conclusion. This conclusion is supply chain finance is a vital aspect of modern business operation that bring numerous benefits to buyers, suppliers, and financial institutions. Of offering early payment option to suppliers, supply chain finance improve cash flow, strengthen relationship, and optimize working capital within the supply chain's network. Okay, thank you for attention. Wassalamualaikum warahmatullahi wabarakatuh.